You're watching the daily market analysis by FinancialMirror.tv. The unexpected rally in US equity markets in late New York trading Thursday can only have two rational explanations. The first one is that levels around the 8,000 level on the Dow are bottomish. During yesterday's trading session, the Dow at one point approached the 8,000 level, which was also the low touched during the October bloodbath. The fact that we have a sort of double bottom formed in October and November could mean that this may be close to the bottom. The other explanation is that the 400-point drop in the Dow in the early part of yesterday's trading was a result of the market getting short rather than the market liquidating positions. This differentiation is crucial because if the market shows signs of stabilization today, as liquidation takes a breather, then volatility could ease in the very long near term. The plunge in retail sales before the market opened was not a good omen, but consumer confidence data later in the day may help the market. Furthermore, the market has little expectation regarding what the upcoming G20 meeting will achieve. G20 leaders will simply call for concerted policy responses, but there won't be any quantitative target for policy stimulus. In other words, the G20 meeting will provide a forum for countries to discuss, but not for bold action. Increased government spending on economic stimulus is something most of the industrials and developed nations that form the G20 are already planning to do. Any shift towards substantive change to the international financial system will probably wait for another meeting after President-elect Barack Obama takes office. As the lack of action from the G20 meeting has been priced in, equity markets could be broadly stable today. Equity market stability could allow for a modest push higher in euro-dollar, but analysts at BNP Paribas suggest to use rallies towards 130 to form short positions. Following the sharp sell-off in sterling over the week, we could see a near-term rally through the 150 handle. We watched the 152 level for direction. A weekly close below this level provides a medium-term bearish signal for sterling against the dollar, according to BNP Paribas. Meanwhile, Commerzbank analysts say sterling has reached its major support at 145.50. The low was 145.60 yesterday, and this is the 61.8% retracement of the entire move from 1985. Any rallies will find interim resistance at 152.60, the October low, but key resistance remains the downtrend at 55.16. Failure to hold 145.50 would negate the call for a corrective rebound and imply ongoing losses to 141.75, the base of an 18-year channel, according to Commerzbank analysts. On an optimistic note, the US economy is in the midst of the worst part of the recession, but growth may return by the second half of next year, according to economists in the latest Wall Street Journal forecasting survey. On average, the 54 economists surveyed expect gross domestic product to decline 3% at an annualized rate in this year's fourth quarter. That comes after the Commerce Department reported a 0.3% drop in the third quarter. Another negative reading is forecast for the first 3 months of next year, with an essentially flat reading for the second quarter. But good news is coming. Slow growth is seen for the second half 2009, reaching 2.1% by the fourth quarter. Have a nice weekend, and thanks for watching FinancialMirror.tv.